Do you want your tenants to cover your monthly mortgage repayments? Hi, I'm Sophia Kazmi and I'm the Director of Maidwell Group. So firstly, we're going to start off with what is an interest-only mortgage. So an interest-only mortgage is a mortgage where you are paying purely interest on the loan amount every month. So let's assume you borrowed £200,000 from a lender. Every month, you will be paying only interest on that loan amount. So at the end of the mortgage term, you will still need to repay the bank the initial loan amount that you had borrowed. Alternatively, there is a capital repayment mortgage, and this is when you pay back part interest and part of the loan amount. So this means at the end of the mortgage term, the mortgage is fully repaid and you won't owe anything more to the bank. Now, a common question we get asked from a lot of our clients is, well, why should you go for an interest-only mortgage as opposed to a capital repayment mortgage? So one of the main reasons why buy-to-let investors typically go for an interest-only mortgage is because of the cash flow. Let's assume that you are renting your property out for £1,500 a month. On an interest-only mortgage, your monthly payments might be £1,000, whereas on a capital repayment mortgage, your monthly payments might be £1,300. That means that on an interest-only mortgage, you will be making a profit every month of £500, whereas on a capital repayment mortgage, you will only be making a profit of £300 every month. So from a cash flow perspective and from a buy-to-let investor's perspective, your cash flow is significantly higher, thus enabling you to grow your property portfolio and spread your investments, which is why you might tend to prefer the interest-only route. Secondly, buy-to-let investors tend to prefer the interest-only mortgage because in the current mortgage climate that we're seeing today, where interest rates are a little bit higher than where we were looking a year ago, having an interest-only mortgage just ensures that your monthly payments are more likely going to be covered by the rent that you're collecting from your tenants every month. So that means that the property will be self-funding. You won't need to look after the monthly payments and you won't need to be putting anything towards keeping up with those repayments every month. And finally, one of the most common concerns is, well, what happens at the end of a mortgage? If you go for an interest-only mortgage, what happens at the end of the term and how do you repay the lender back? And this is done through three main ways. One can be through selling the property. Secondly, you could pay off the property through savings or investments. And thirdly, you could look to remortgage. So firstly, if we talk about selling the property, typically property prices in the UK tend to double every 15 years. So let's assume you bought the property for £200,000 and then in 15 years time, you sell the property for £400,000. You could repay back the lender, pay off the loan amount, and then take your profit and move it on to the next investment. Secondly, you could look to pay off the property through savings or investments. So for example, you may have had savings alongside the mortgage running for the last 15 years, or perhaps if you've had investments that you want to liquidate, you can repay the bank that way. And thirdly, one of the most common ways in which you repay a lender back at the end of an interest-only mortgage is through remortgaging. And this is when you find a lender to take on the loan amount and then the existing lender is then repaid. At that point, you could then look to also capital raise. So being the property has gone up in value, as we have mentioned, you could then look to take out the equity that you've built up in that property, grow your property portfolio as you would then take that equity and invest it onto the next investment. And this is typically what a buy-to-let investor tends to do. At that point, when you do remortgage, you may also have an option of potentially lower interest rates. And that is because perhaps when you first purchased the property, you may have been a first-time buyer, or you may not have had a UK footprint at that point. So you would have been paying higher interest rates as a result. However, when you come to remortgaging the property, in the eyes of many UK lenders, you would be considered as having mortgage experience, at which point you will then have access to slightly more competitive interest rates. So this is typically the cycle of a buy-to-let investor. They will remortgage at the end of an interest-only facility and then take the equity out and then invest that into the next property and potentially at a lower interest rate. So I hope this has answered many of your questions and hopefully overcome a lot of your concerns around interest-only mortgages and what happens at the end of an interest-only mortgage term.